The financial system of the United States has evolved over more than 2 centuries, shaping not only its domestic economy, but also its global standing. From the early years after independence, through wars, financial panics, institutional reforms, and technological revolutions, this evolution reflects both resilience and transformation. In this documentary, we explore how America built its financial architecture and how that structure allowed it to become a global financial leader. After gaining independence, the United States faced serious economic instability, war debts, a weak credit system, and no unified currency. Alexander Hamilton, the first Secretary of the Treasury, proposed a bold solution: to centralize public credit, establish a national debt, and create a national bank. In 1791, Congress chartered the first bank of the United States, supplying capital and granting it authority to issue notes, facilitate government borrowing, and stabilize the early American economy. Although it was not a modern central bank, it did not control monetary policy, set reserve requirements, or act as a lender of last resort. It served as a critical fiscal agent for the federal government. During the Civil War, the U.S. government needed reliable revenue and a more organized banking system. In 1863, Congress passed the National Currency Act, which created the Office of the Comptroller of the Currency, OCC. In 1864, this act was strengthened and transformed into the National Bank Act, establishing nationally chartered banks and a uniform currency. To issue national banknotes, banks had to hold U.S. government bonds as collateral, which helped both fund the federal government and stabilize the currency. The OCC, meanwhile, supervised these banks to ensure safety, soundness, and regulatory compliance. Despite the national banking system, periodic financial panics continued, one of the most severe being the Panic of 1907. This crisis highlighted the absence of a central institution that could provide liquidity in times of crisis. In response, the Federal Reserve System was created by the Federal Reserve Act of 1913. The Fed was designed to manage the money supply, provide a backstop for banks, and act as a stabilizing force in the financial system. The stock market crash of 1929 and the ensuing Great Depression revealed major weaknesses in the banking system. To restore confidence, the U.S. government introduced sweeping reforms. One landmark was the Glass-Steagall Act of 1933, which separated commercial banking from investment banking to reduce risk. At the same time, the FDIC, the Federal Deposit Insurance Corporation, was established to ensure bank deposits, preventing bank runs and rebuilding public trust in financial institutions. After World War II, the U.S. solidified its economic and financial dominance. The Bretton Woods system, established in 1944, pegged the U.S. dollar to gold and made it the world's primary reserve currency. This system gave the U.S. enormous influence in global finance, as other nations tied their currencies to the dollar. Meanwhile, U.S. banks and multinational corporations flourished, and financial markets diversified with the growth of non-bank financial institutions. In 1971, President Richard Nixon ended the convertibility of the dollar into gold, a move known as the Nixon shock. This effectively ended the Bretton Woods system, and the dollar became a fiat currency, meaning its value rested on trust in the U.S. government, rather than on a physical commodity like gold. From the late 20th century onward, the U.S. financial system underwent profound transformation. Deregulation, especially in the 1980s and 1990s, allowed new financial products, like derivatives, to flourish. Technological advances, such as electronic banking and computerized trading, further revolutionized finance. However, This growth came with heightened risk. In 2007 to 2008, the global financial crisis erupted, triggered largely by high-risk mortgage lending and the complex securitization of debt. As a response, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010. This law strengthened regulation, introduced new oversight bodies like the Financial Stability Oversight Council, and created the Consumer Financial Protection Bureau to protect consumers. Today, financial innovation continues. Fintech, digital currencies, and artificial intelligence are reshaping how money is created, stored, and exchanged. The story of America's financial development is one of continual adaptation. From Hamilton's first bank to today's high-tech financial ecosystem, crises and reforms have repeatedly redefined the system, and innovation remains at its core. Understanding this history is vital not just for seeing how we got here, but for imagining where we might be heading next.